Welcome back, Accounting 202 students. Before we move on to amortization and depletion, I wanted to do a quick review of over fixed assets. So what we started off with was the purchase of fixed assets. And really, when we were walking through that issue, the big thing was that we wanted to record those assets for what we paid for them in order to get them into their intended use. Right? And so, if we had to pay for the transportation to get that equipment to our location, that would actually not be a transportation expense, but that would actually be part of the equipment. All right. And so we ran through a bunch of those scenarios. The next thing that we did is we depreciated those assets. All right. And again, we only depreciate the equipment and the buildings. All right. Because land is never depreciated, if you remember that. Now, this is important. The reason that we're doing the depreciation really all comes down to the matching principle. So again, if you remember the matching principle, we talked about that in chapters 2 and 3. And the matching concept or the matching principle basically says that we want to record the expenses in the period that we earned them, and we want to match the expenses to make those revenues during the same time period. All right. And so the matching concept or the matching principle is basically recording the revenues when you've earned them, which is also called the revenue recognition principle, and record the expenses when you incurred them. It doesn't matter when the cash changes hands. And so when we did the adjusting entries in chapter 3, that matching principle and the matching concept was the driving rationale behind that process. Right? Now, you need to also know, and I think this might be an exam question, right, on the final exam, that the matching concept is also called accrual-based accounting. Right? So there's really only two bases of accounting. There's the accrual basis of accounting. That's the matching concept. That's generally accepted accounting principles. All right. So those are the rules that we use for accounting. But then there's this thing called the cash basis, and that is what is actually used for tax purposes. All right, that's not part of this semester or this principles at all, and so you don't really need to worry about that. Okay, so once we've purchased these assets and we've used those assets, then we disposed of those assets. And so there's three ways to dispose of an asset. We sell that asset. We can also abandon that asset, or we could actually trade that asset in. All right? And so in previous videos, we covered the sale and the abandonment of assets. The trading of assets really is beyond the scope of this course, and so we're not really going to get into it. But just a little FYI, when we calculate gains and losses, remember from previous chapters, we compared, or not previous chapters, previous videos, we compared the price that we received to the book value of that asset. And if you remember, book value was the historical cost that we paid, subtract the accumulated depreciation. That gives us book value. And so if we had a book value of $2,000 for an asset and we sold that for $3,000, we would have had a $1,000 gain, wouldn't we? All right. Now, if we would have sold that same asset for $500, we would have had a $2,000. So we would have had a $1,500 loss, right? So those are gains and losses. When it comes to a trading in of an asset, all right, we're going to compare the trade-in allowance, all right, to the book value. So let's say we still have that same asset. The book value was $2,000, and let's just say it was a vehicle. We brought it to the dealership, and they said, hey, if you push, pull, or drag, that vehicle in, we'll give you $3,000 towards the purchase of a new vehicle. Well, that's a trade-in allowance. And so if we had an asset that was worth $2,000 and somebody's willing to give us $3,000 for it, well, that is a gain, isn't it? $1,000 gain. Right? And so that's the whole idea of trading in an asset. So we can sell an asset, we can abandon an asset, or we can trade that asset. Okay. Well, there's one thing that we also need to discuss when it comes to fixed assets. Right? And really what that is the difference between a capital expenditure and a revenue expenditure. A capital expenditure either makes an asset better or last longer. And a great example of that would be we have a delivery truck and we completely overhaul the engine, right? And so that's actually going to make our delivery truck last longer. Okay? And so that would be what's referred to as a capital asset. Now, the changing of oil in that same delivery truck is what is referred to as a revenue expenditure. We're going to expense that. We're not going to increase the value of that fixed asset. And so a revenue expenditure shows up on the income statement, right, as just a ordinary maintenance expense, right? Because if you change the oil when you're supposed to change the oil, that doesn't extend the life of the asset. Okay, but I'll tell you what, if you don't change the oil, okay, that's definitely going to shorten the life of the asset, right? Okay, and so that's the difference. A capital expenditure, you're going to, so the journal entry, right? If it was a capital expenditure, let's say we spent $8,000 on overhauling the engine in the delivery truck. Right? What we would do is we would debit the equipment, the delivery truck, and we'd credit whatever cash. That's what's referred to as a capital expenditure. A revenue expenditure, okay, we're just going to do repairs and maintenance expense and cash. And generally there's a price difference. And so, let's go ahead and work a problem, right? And so I'm in chapter 10, and let's see. Why don't we go ahead and do PE 10-5B, right? And so I'm going to switch over to, I'm going to turn off my video and switch over to sharing my screen with you, and we will stop video. Okay. And we'll work this problem. And so this problem, it reads, okay, again, this is PE 10-5B. So PE 10-5B. Okay. And this problem says, hey, we have Green River Inflatables Company paid $1,675 to install a hydraulic lift, to make their delivery truck, okay, and $40 for an air filter for one of its delivery trucks. Okay. Journalize the entries to show the new lift and the air filter expenditure. And so in this case, because this didn't make this delivery truck last longer, but it made it better. All right? And so there's two different types of capital expenditures. Capital expenditures that extend the life of the asset, or a capital expenditure that makes that asset better. All right, and so we had this delivery truck, all right, and before, every time we had to unload those inflatables, okay, we had to lift them up and put them in the back, or drop them down off the back of the truck, which causes wear and tear. And so what this company did is they put a hydraulic lift, right? So I don't know if you've ever seen a delivery truck, but they wheel the stuff onto the lift and then it slowly lowers it down. That saves the backs, I'll tell you what, of your workers for one thing. All right, and so if that was the case, what we've done is we've made that piece of equipment better. And so what we're going to do is we're just going to say, hey, this was delivery truck, right, or equipment truck, and that was for $1,675. And we're going to credit the cash that we used to pay for that. Well, it also says that, hey, we also changed the air filter on this thing, all right, for $40. And so again, we're going to have $40. And instead of being the equipment, right, we're just going to have a repairs or maintenance expense. Right? And so this Okay, this thing is going off to the balance sheet, and this is going off to the income statement. This is what's referred to as a period expense, because we're just expensing it in the period, right? And this is what we refer to as a capital expenditure. So that pretty much wraps up dealing with fixed assets. The next section, right, deals with not intangible assets. It deals with natural resources. Okay, so a natural resource could be a gold mine. It could be a forest. You know, so if you're harvesting trees, and with natural resources, okay, as we take those resources out, oil wells, gold mines, diamond mines, coal mines, whatever, all right, it's a natural resource. We purchased those resources, okay, either we bought the land or we purchased the mineral rights. Okay. We need to, again, spread, okay, the cost of that purchase over the time period that we're going to get a benefit from. All right, and so again, this has everything to do with the matching concept, because we're going to say, hey, as we take that gold out, we want to expense against it, right, the cost that we incurred in order to buy the rights to that gold. And so a depletion, okay, is similar to depreciation. Right? It's just spelled different. All right, depletion, that goes with your natural resources. Depreciation, right, that goes with your fixed assets. And so let's go ahead and work a problem, all right, because again, it's all about the matching concept, all right? And so I'm going to work PE 10-2, or no, I'm sorry, 10-7A. And this says Glacier Mining Company acquired mineral rights, right, for $494 million. The mineral deposits are estimated to be 475 million tons. Right? During the current year, they took out 31,500,000 tons, right, out of this mine. Okay. And so I don't know how many of you guys ever seen those. I think it's on the Travel Channel or whatever. But you know, they're the gold rush, you know, up in Alaska, and you know, they're trying to extract, you know, gold from, you know, the ground or open pits, or they're panning for gold, right? Well, in order to do that, they had to buy the rights to take that gold away, right? And so that's what that's basically what we're doing, and we're trying to match the cost. See, to get those mineral rights, we had to pay $494 million. All right, and so I don't know if you remember, okay, but when we were talking about depreciation, there were three different methods we talked about. Straight line rate, which, you know, the majority of the people use the straight line rate. Okay. Then there were the units of production, and then we had the double declining balance. Right? Well, when we're talking about depletion, we're basically going to use the units of production, right? Because we basically, when we paid this $494 million, we estimated that we're going to be able to pull out, you know, 475 million tons. All right, they don't tell us what this is, but I doubt it's gold, because that would be a lot of gold. You know, it's probably coal or iron ore or something to that effect, right? But see, we're going to get the benefit, or an assumed benefit, of this 475 million tons of ore. And so when we did the units of production, okay, if you remember, we took the cost and we divided it by some sort of unit. This gave us, you know, the rate of depreciation or depletion. So in our scenario here, we basically had that 494 million And for that $494 million, we assumed, right, because it's an estimate, that we're going to get 475 million tons of ore. Let me grab my calculator. And so forth. We find out, okay, that, oops, we're going to pull out $1.04 per ton. So that's the cost, right? You know, as an estimate per ton, okay, when we purchase this stuff. So this is an estimate. Well, if you remember, that was step one. Step two, because again, this is the units of production. We did a calculation very similar to this. In step two, it basically says, hey, as we pull the tons out, okay, we need to come up with the depletion, right? So the depletion expense is going to be our rate, that from here, okay, multiply it times the actual units. And so in this scenario, we had 1.04, and they have to tell you, okay, that we pulled out 31,500,000 tons. And so our depletion expense, we're just going to take that 1.04, going to multiply it times 31,500. And we're going to have depletion expense this year of $32,760,000. So to journalize this, what we're going to do is very similar to depreciation. What we're going to have is we're going to have depletion expense, 32,760, and we're going to have accumulated depletion. And so this would be the journal entry. Actually, that's a 3. Oops. This would be the journal entry to record depletion expense. Well, the last thing that we need to deal with, right, are intangible assets. Okay, an intangible asset. Okay, you remember at the beginning when we talked about fixed assets and their different characterizations, right? When we were talking about fixed assets, we said, hey, they're tangible, which just means you can touch that. Okay? Well, an intangible asset, okay, is an asset that you cannot touch. And so I don't know if you know the song by MC Hammer, but you can't touch this. All right, but those are these types of assets, and they're generally identified as a legal right that you have. Okay, and so with intangible assets, okay, there are patents. Okay, and a patent, all that really does is it protects you. So if you've invented something, right, it protects you from other people using your idea. Now with patents, it does have a limited number of years, okay, that you have this protection, right? The textbook talks that there's 20 years, all right? So we're just going to use that as a norm. You need to know that patents have different lifespans, all right? But we're just going to stick with 20 years, all right? So if you came up with a new idea, okay, nobody can use your idea, right, unless they pay you, okay, for 20 years. Then we have copyrights or trademarks. Okay, a copyright is if you're an artist and you wrote a book, right, you would have that book copyrighted, or a song, or an artwork, right? Those are copyrights, which again, nobody can use your book or use your image or your song without either paying you or getting your permission. Whereas a trademark, right? You know, a trademark is a symbol or a picture that represents your company. Right? A trademark, you know, probably the most recognizable trademark in the world is the Coca-Cola trademark, right? I mean, everybody around the world, they see, you know, the symbol for Coca-Cola, you know, they know that that's Coke. Or another one is Nike, the Nike swoosh, right? If you see that swoosh, everybody knows that that is a Nike product, right? Now, what's interesting about copyrights and trademarks is they have what's referred to as an unlimited life. Well, that's not true. With copyrights, as long as the artist, you know, the author or the painter or even the photographer, if as long as they're alive, okay, there is no end to that copyright. Right? As long as they're alive, you have to actually pay them to use their image or their song or whatever. However, when they die, the estate, right, can, you know, maintain that copyright for 70 years after they die. All right, and so it's kind of interesting. You know, Michael Jackson, when he was a young kid, you know, he met up with the Beatles. I don't know if you guys know who the Beatles are. I'm sure some of you do. All right, but he met up with the Beatles, and one of the things that the Beatles did not do is that when they came out and released their songs, they did not, even though they wrote them, right, their record company, they kept their copyrights. And so, you know, the Beatles didn't even own their own songs. It was the record label that owned them. All right, and so the Beatles told Michael Jackson, hey, whatever you do, make sure that you get your copyrights. Well, Michael did, right? And even more than that, he actually went and he bought the Beatles copyrights. Right? So he actually bought up songs of the Beatles without the Beatles knowing. And there was actually a little, you know, they were pretty pissed, all right, because they gave him this good advice, and then he goes around and so actually Michael Jackson's estate owns the Beatles songs. Well, if you know anything about the Beatles, they're not all dead. All right, there are two that are still alive, Paul McCartney and Ringo Starr. All right, and so the copyrights are still good. But Michael Jackson has died, hasn't he? And so all the songs that Michael Jackson wrote and recorded, all right, his estate can have a copyright for 70 years. Right? And so the rules are, if the artist dies, those copyrights are only good for 70 more years. Something that's interesting, Elvis, all right, and this is actually true with Michael Jackson also. Elvis, when he died, okay, he wasn't broke or anything like that, but his estate now is worth more, okay, that he's been dead than it was ever worth when he was alive. And that's the same thing with Michael Jackson. You know, his estate owns all those copyrights on the song, and so anytime somebody wants to use a Michael Jackson song or a commercial or something like that, they have to pay Michael Jackson's estate. And so his estate is actually better off now than it was when Michael Jackson was alive. All right. And so the rule, copyrights, after the artist dies, there is a limit, right, to how long that intangible asset is good for. After that 70 years, it becomes what's referred to as public domain. Right? And so, you know, I guess Shakespeare, a lot of his writings, okay, you can use his quotes and things like that because he's been dead for more than 70 years. I was actually trying to think of Beethoven. You know, if you want to use Beethoven's music, you can. Okay, but if you actually were to use the New York Symphony's rendition of Beethoven's music, well, that New York Symphony has a copyright on that performance. But you can actually use Beethoven's music, but you have to actually generate it yourself. Right? So just something interesting. With trademarks, they last forever. Okay, you can, you know, basically every 10 years you have to file some paperwork, It's not that expensive. I think it was like 20 bucks or something like that. And you can renew your trademark indefinitely, right? And so Faith Writing Company actually owned the name, right? And it was a trademark of Faith, right? It was kind of interesting because Writing Company was too generic and we couldn't own that. But we owned Faith for surf clothing wear and accessories. The next intangible asset is goodwill, right? And goodwill is kind of interesting in the fact that goodwill can only be generated, right, when one company buys out another company. And so, as I've shared, I work for the surf clothing company, Faith Writing Company. Well, we had several people come and offer Tony, who was the owner, $1 million, right, to buy Faith Writing Company. Well, I can tell you what, at any given point in time, the value, all right, the asset value, so we never owned a building, we never owned land, right? Yeah, we owned maybe a couple $100,000 worth of inventory and some office equipment, right? So probably at our best, okay, if you were to look at the fair market value of our assets, right, we maybe had $300,000. So why would somebody come and give us $1 million for something that they can go out and get themselves for 300,000? Well, the reason being is that we had a really good reputation, right? When people saw our line, they're like, that's a good line, Tony Moniz, surf. And so they saw that the value, right, was more in our reputation, okay, than our actual assets. And so if a company did pay, $1 million, okay, they're basically going to say, hey, we paid cash for $1 million. We can record those assets, all right? So I'm just going to lump all their assets, okay? When they paid us the $1 million, okay, they got all of our assets. So just do assets. And so, let's say we had $300,000. Well, obviously, if you know anything at this point, debits and credits have got to balance, right? And so there's got to be a $700,000 debit here, okay? That it was a Japanese firm that was offered us $1 million, right? They have to have a debit here. What they would record this thing is for good. And so, how long does goodwill last? Well, it lasts indefinitely, right? As long as you maintain the reputation, okay, that goodwill will last. And so, what you need to understand from this part of this chapter is that we need to match the costs of these intangible assets, okay? And so, a patent, right? You could either file a patent or we could buy a patent from somebody else. Okay. And so I'm going to make up my own problem because there's a homework problem that's very similar, right? That you're going to have to be able to do. Okay. And so I'm going to make up my own scenario. We're going to buy an intangible asset. Okay. We're going to buy somebody else's patent. My neighbor, he's somewhat of a genius. He's definitely an entrepreneur. Okay. His background is in engineering, right? And he's come up with several inventions, right, that he has gone ahead and gotten a patent on. One of them is a blower that you can attach, right, to your lawnmower, okay, that almost triples the blowing power of the most heavy-duty leaf blower out there, all right? And so he's already patented this, and he's actually going around to like John Deere and Exmark and seeing if they want to buy his patent. All right. And so let's say that they do. All right. They go ahead and they buy his idea. And so we're going to be, let's say we're Exmark. All right. And so we're going to buy this patent that my neighbor already created. Okay. And so the purchase, okay, so we're going to purchase this patent for $3 million. So we're going to purchase the patent for $3 million. So the journal entry, okay, is going to be a patent. Okay, and it's going to be cash for $3 million. Okay. Well, because a patent has a limited life, we need to do this thing called amortize it. Right? So amortization is actually the same thing as depreciation or depletion. All it's doing is it's matching the cost, right, against the revenues. See, because if Exmark purchased this patent, all right, they could come up with this new attachment to their lawnmowers, okay, and they're going to sell this, right? And so they're going to generate revenues from that, okay, and it only costs them this $3 million, right? And so what they want to do is they want to match the cost, right? And so let's say, right, we're going to amortize. Okay, we're going to amortize this for 15 years, right? I actually don't know. You know how long he has actually owned my neighbor has owned this, okay, but if my neighbor had done it 5 years ago, all right, he's had that right, all right, because if you remember, patents are good for 20 years, right? He's had that right for 5 years. There's only 15 years left of this, all right? And so for 1 year's depreciation, what we're going to do, all right, we're going to apply straight line amortization to this. Okay, so straight line amortization, right, or a straight line depreciation, we talked about this, it's really easy. All you're going to do is you're going to take, you know, so this is going to be amortization expense. It's going to be the cost divided by the estimated life. Okay. And so, because there's 15 years left, right, we're going to take our 3 million and we're going to divide it by 15. And that comes out to be $200,000 a year. Right? Okay. And so, okay, there's actually 2 ways that you could journalize this. All right. And so the journal entry, it's going to be amortization expense. And I think the textbook, all right, let me just see if I can find that real fast. Yeah, all right. They actually, instead of doing an accumulated amortization, they actually just reduce the patent. And so we'd record this for 200,000. The alternative way, okay, would be to record the amortization expense, okay, and accumulated amortization, just like, all right, we did with the depreciation. And so I want you to know that amortization, all that means is that we're spreading it out. To amortize something is to spread something out. So you need to know that depreciation is a form of amortization. Depletion is a form of amortization. And so obviously amortization is used for patents as far as the terminology. Okay. Well, the deal is, okay, let's say somebody starts to use, you know, our idea, and we take them to court. And so if we take them to court and we spend another $300,000, okay, so let's say 5 years later, 5 years later, we spend $300,000 to defend our patent. Okay. So we spend $300,000 to defend our patent. Okay. And so And this, I should say, successfully, all right? Successfully defend our patent. And so what we're going to do, all right, is we're going to record patent and cash for 300,000. Okay. And so what is, all right, the value of our patent, okay, after 5 years? Well, if you remember, okay, we spent the $300,000, right? So the historical cost, I'm sorry, $3 million. Right? Okay, we've amortized it for 5 years. Okay. We're amortizing this, all right, at $200,000 each year. And so we have amortized already $1 million. And so this is our amortization. So we have something that's worth $2 million. But because we successfully defended it, we have to add the 300,000. And so now we have, by the way, this is what's referred to as the carrying value. And this was the defense. Okay. And so now we have 2,300,000 that we need to spread over 15 years? No, over 10 years, right? We had 15 years left. We've been amortizing it, $200,000 every year for the past 5 years. And so that's why we subtracted this. Okay. We're going to spread this over the remaining life of 10 years, okay, or 2, 3, 0. I'm sorry, that too many zeros. So this is the new amortization. Okay. Now it's interesting, if we lose, if somebody uses our idea and we take them to court and we lose, we end up expensing, all right, the full amount, okay, in the year that we actually lose. Because if we can't defend our patents, okay, do we have, right, an intangible asset? The answer is no. Okay, if somebody can use our idea, okay, without paying us or anything like that, then we don't have an intangible asset. We do not have a right. Well, the last thing in our chapter is this thing called the fixed asset turnover ratio. With the fixed asset turnover ratio, we've talked about other turnover ratios before. All right, if you remember, they always, in the name, okay, they give you the denominator, right? And so because it's a fixed asset, okay, we're going to take the average fixed assets. And to get that, you're going to take the beginning of the fixed assets and the ending fixed assets, add them together and divide by 2. Okay, that's going to give you an average. And then you're going to divide that into sales. And if you look in your textbook, all right, they actually show the calculations for this. They give us a name. Oh, McDonald's Corporation, right? And they come up, right, with this fixed asset turnover ratio of 1.10. Now, what this is really saying, it's saying for every fixed asset, every dollar in fixed assets that we have, we use those fixed assets to generate a $1.10 in sales. So the question is that good? Is that better? And so again, whenever we talk about financial ratios, you want to do two things. You want to compare from year to year. Okay? And so if last year's McDonald's fixed assets was 1.05, well, 1.1 would be better than last year. But that just tells us if we're doing better than last year. If we want to know if we're doing good or not, we want to compare it to people that are outside of our firm. Right? And so if you look at the end of the textbook, at my textbook page is 512, right? You can see that McDonald's is 1.1, whereas Sonic, right, a direct competitor, is 1.4. So what's that mean? Well, that means that for every dollar in fixed assets that Sonic has, they're able to generate $1.40 in sales. That's better, isn't it? It's better than McDonald's. Wendy's is 1.5, right? Jack in the Box is 2.1. If you go all the way up, right, you can see Chipotle, which I like Chipotle, all right, that is 3.94. Now, I would beg to differ that Chipotle and McDonald's are not in the same industry. I guess fast food it is, but there is a difference, I think, between Chipotle and McDonald's. But basically it's saying that for every dollar in fixed assets that Chipotle has, they're generating $3.09, right, in sales. And so they would definitely be doing that. Okay. Well, that kind of wraps it up for chapter 10. I hope, if you have any questions, please ask me when we're doing our in-seat class, and hopefully I can answer that for you. I better be able to answer. I am the teacher, right? Right. Great. Well, thank you. We'll move on to chapter 11.